So our first speaker is Pia ORRENIUS. Pia is a labor economist, and she works on regional economic growth and demographic change. She manages the Regional and Microeconomics Group in the Dallas Federal Research Department, is executive editor of the quarterly publication Southwest Economy, and she co-edited 10-Gallon Economy, Sizing Up Economic Growth in Texas. Her academic research focuses on the labor market, impacts of immigration, unauthorized immigration, and U.S. immigration policy, nothing that's timely or important lately. She's co-author of the book Beside the Golden Door, U.S. Immigration Reform in a New Era of Globalization. She's affiliated with several academic institutions, including a research fellow at the Tower Center for Political Studies at Southern Methodist University and at the IZA Institute of Labor in Bonn, Germany, as well as an adjunct scholar at the American Enterprise Institute. She's also an adjunct professor at Baylor University at the Dallas campus, where she teaches in the Executive MBA program. She was senior economist on the Council of Economic Advisors in the Executive Office of the President, Washington, D.C. in 2004 and 2005, where she was an advisor to the Bush administration on labor, health, and immigration issues. She holds a PhD in economics from the University of California at Los Angeles and bachelor degrees in economics and Spanish from the University of Illinois at Champaign-Urbana. So the thing I should also mention, we're going to have time for questions at the end. You may not have noticed there were some cards out there that you could write down your questions. But if you didn't, it's okay. We have mics at the front. And so if you have the cards and you want to write out a question, we'll be collecting those for the panel part at the end. But if not, you can come down. You'll have a chance to speak into the mics and ask your group a question. So as you listen to Pia, be thinking about what you'd like to learn more about. So with that, please join me in welcoming Pia to the stage.
Thank you, Dean. Great. All right. Great. Well, good morning, and thank you for having me. It's a great pleasure to be here and to be co-hosting this with UT McCombs. Let me get started. So I called this regional economic update really conditions good and the outlook brightening. So on the whole, I think I have positive news. Certainly, I would say this year is starting out better than sort of this time last year. If you remember, things were looking a little gloomy last year. And I think we're more optimistic for 2020 than we were 1 year ago. So the roadmap, the regional economy is healthy overall, or it was in 2019, and so we don't have any data yet from 2020, but the outlook is pretty bright. In 2019, the Texas job growth was close to trend, as I'll show you, which is a good year. And tight labor markets are certainly pushing wages higher. They're also constraining growth, so that's one concern. Migration into Texas picked up, and I'll show you some of that data. And the reason I mention that is for 2 years after the oil bust, 2015 and 2016, we saw a pretty sharp decline in the volume of in-migration into the state. And as I'll point out to you, in-migration into Texas is really crucially important because we have a much higher job growth rate than the nation, and the only way we can sustain that rate is to bring people from other states. And countries, I should say. And the consumer is strong, and I'll show you that as well. In terms of the headwinds going into 2020, I would say the headwinds from 2019, they're still there, but they're either stable, some may be dissipating slightly. So I think this is sort of what's boosting our outlook for this year. So labor markets are tight, which is a constraint on growth, but they're stable. So we haven't seen any further tightening of labor markets, so that's a positive. We worry, again, because tight labor markets means it's harder to hire, and then it's, obviously more difficult to add jobs. We've seen that investment has been quite suppressed in 2019. Part of that has been due to trade policy uncertainty. Some of that has been relieved with certainly this phase 1 agreement with China that was signed this week, and also with what looks like will be the ratification of the USMCA, which is the next NAFTA. So that uncertainty dissipating will help probably boost investment. The other part of the suppression of investment, though, is the weak energy sector. And so we are concerned that's going to continue into 2020. We don't see really things improving much in the energy sector. So that's one concern, certainly, going forward. As I said, the energy sector is weak. The pace of decline is slowing a little bit, so at least we'll look at that as well. And then lastly, what we saw in 2019 really was a downshift in global growth and the global economic outlook. Certainly here, closer to home, we saw really a complete stagnation of growth in Mexico, which is bad for us because they are our #1 trading partner. But there are some positive signs emerging globally, and I think we've gotten some good news lately. And so there is another situation where, although we're not projecting faster global growth necessarily, we are projecting a stabilization. All right. The way I structured this is I talk a little bit about the national economy, then we move to Texas, and then we'll talk a little bit about Austin. And so on the national economy, just want to point out two things. So U.S. job growth continues to be solid. And so what I have here is just the month-on-month job growth in levels. And so you can sort of see those averages also. Those red lines are the averages for every given year. And then there's these bars that we're calling a stable unemployment rate range. And so what you need to understand is that we've really been operating beyond the long-run sustainable capacity of the U.S. economy in the sense of our growth, because we've been pushing the unemployment rate down and down. And even at, December job growth was 145,000, but even at that level, it's above our stable unemployment rate range, which means we're still adding jobs at a rate at which the unemployment rate can continue to decline. And so the reason that we could actually do okay with even slower job growth is because our labor force, our workforce growth is so slow. And the reason for that is the retirement of the baby boomers and the aging of the labor force. And so we're really moving into this decade and the next decade into very slow sort of natural labor force growth. And so we're not going to be able to sustain that job growth of years past. So that's in the sense of which even at an average rate of adding jobs at 176,000 for 2019, that's still really above sort of our long-run sustainable job growth for the U.S. On the GDP data, it's really quite interesting. So here I'm just showing in blue Q3 GDP growth for the U.S. at 2.1%, and then I'm showing you in red the projection for Q4 based on the Atlanta Fed Q4 GDP now. And so we're projecting another pretty strong Q4. And the interesting thing, though, is if you look at the breakout of the components, so if you look to the right of the dashed line, you'll see the contributors to GDP growth in percentage points. And what you'll see there is that the first set of bars, which is consumption, are quite strong. And really, they're driving GDP growth nationally. Look at the second set of bars. Now, that really is our concern. Very weak investment. So they're contributing negatively to GDP growth. So non-residential fixed investment has been a drag on growth in 2019. It came a little bit as a surprise. Some of this is energy, some of it's trade policy uncertainty. But certainly for a while there when we were looking, are we going to go into a downturn or are we not? It would have been, in that case, an investment-led recession because the consumer looks strong, consumption is quite strong. Really the weakness in the economy nationally is this weak investment. All right, so moving to the Texas economy, I always want to start with, I start with a map of the Federal Reserve District. Just to remind you, we're in the 11th Federal Reserve District. There, the green, which looks really big, but it's mostly Texas. 95% of our 11th district economy is Texas, which is why we follow Texas so closely at the Dallas Fed. But more importantly, this is to remind you that you're very lucky to be living in the 11th Federal Reserve District. This is showing you employment growth really since the Great Recession by Federal Reserve District. So there's 12 possible regions here. And you're certainly living in the one that has the outsized job growth performance. So we're very lucky in the sense that this region has just been a superstar performer in terms of adding jobs and growing the region. And so you can see there the red line is job growth in Dallas. It's all normalized so that you can compare the growth rates. And then it's followed by San Francisco and Atlanta. San Francisco district obviously includes California and really the whole West Coast. And Atlanta is the South. So those are really the strongest regions. And that was true before the recession as well. So we could go back and see similar patterns. But it really is fascinating to see this outsized growth in our region. And I think it's good to remind ourselves of that we're spoiled in that sense. All right, so this is another view of looking at Texas job growth. This is just annual growth, just to show you where we are or where we were in 2019. I've sort of circled the last set of bars. We grew at 2%, at least through November. We haven't gotten the December data yet. I think we get that tomorrow. And the US grew at 1.4%, which is pretty good for the US. But again, Texas is growing usually significantly above, at a faster pace than the US economy. Of course, the downside to this, or the positive on one hand, and also a constraint on growth, is the tight labor market. So a really unprecedented record lows of unemployment rate, both in the US and in Texas. We've never seen unemployment rates this low. You can go back to as long as the statistics have been kept, and in Texas, and you'll never see a lower unemployment rate. So this is unprecedented for us, and basically it's positive for workers, because obviously it boosts wage growth, but it also makes it, like I've mentioned, harder to add jobs for employers. And that's something, when we run our surveys at the Dallas Fed, we hear that repeatedly. Our business contacts complain about the difficulty finding workers. Now, I also mentioned earlier, the only reason we can grow faster in our district or in Texas is because we have this large net in-migration. Here I'm just showing you annual net in-migration going back to 2000 for Texas, and I've divided those bars up into domestic migration, so migrants from other states, and into international migration. So domestic migration is in blue, and you can see it's been very strong during this period since really the last 12 plus years or so. And that coincides with the fracking boom, of course, and so I think that's been a large draw. The other more concerning observation you can make when you look at this chart is that really, it's hard to see here, but there has been a decline, a significant decline in the size of the gray bar. So international migration is slowing. And the reason that we're a little bit concerned about that is because international migration, domestic migration is also going to have to taper off, because again, the US population is aging, and as we age, we're less likely to move across state lines. So we are in the future going to be more reliant on international migration. So it really is not something that you want to see going away. The other interesting thing about migration so the reason I put this chart here is because our closest competitor for net migration is Florida. And so I say, well, so Florida some years adds even more net migrants than Texas does. But then we looked at the reasons for people. Why do people go to Florida? Why do people go to Texas? And so here you can see Texas, of all states, was the one state where people most relocated for a job. So really here it's the labor market. It's not that they're coming here to retire, which Florida attracts a lot of retirees, workers as well. And they're not coming here for the amenities, which is also kind of funny. Although they may be coming to Austin for the amenities, but it's really for jobs. When you look by industry, what kind of job growth are we generating? We really had broad-based job growth here. You can see by industry here, I'm comparing US in gray with Texas in blue, and you can just see outsized job growth in 2019 in construction, financial activities, education and health services, professional business services. The only sector that's losing jobs is energy. And we probably expect that to be the case going forward as well. So what's going on in the energy sector? Well, here you can see in red is a declining rig count. So activity is declining in the energy sector. And this is for Texas, but it's true nationally as well. Even though the oil prices have firmed a little bit in recent months, we still see this declining energy activity. For a while, we saw well completions. Even as rig count went down, well completions were up. And so here I'm showing you well completions in red, and you can sort of see how that ticked up at the end of 2018 and then sort of remained high in 2019, but has recently gone down. So rig count well completions are falling. So that's the sense in which the energy sector is weak and activity is declining. So we'll still add more oil output this year, certainly. Oil production is set to increase, but not at the pace of this past year. In our Dallas Fed Energy Survey, which just came in a few weeks ago, this is for Q4, I've sort of circled so you can see, this is a diffusion index, so you can see those negative bars means that business activity is still declining according to our Q4 energy survey. Investment is still very close to zero in terms of being flat. Capital expenditures in the energy sector. Employment is still negative, so it's declining as well. But I also circled company outlook because it actually turned slightly positive in the Q4 survey. So also uncertainty moved down, so there's a little bit of good news here for the energy sector in terms of hopefully the pace of decline will slow in 2020 compared to 2019, and things will stabilize. I want to also show you Texas exports is another, well, that's really a bright spot in the economy here. I've sort of normalized growth so that you can compare Texas in blue to the rest of the nation there in gray. And what's fascinating is just the tremendous growth in Texas exports. So I start the chart in 2002, and that's significant because it was in 2002 that we became the #1 exporting state in the nation, surpassing California. So California is a much larger economy than Texas, of course, and a larger manufacturing sector. So it's very significant that we actually have far more exports than California and, of course, all the other states. So we are the #1 exporting state in the nation, and we've had this tremendous growth. I mean, one concern is that it does expose us to trade policy uncertainty, to tariffs and other things that have been happening in the policy arena on the trade front. Now, most of our trade is not with China, but a lot of it is with Mexico and Canada, in fact, close to half. So this USMCA agreement was really important to Texas. Of course, we don't think it's as good a trade agreement as NAFTA. It's more restrictive, but it's still, good to have it in place and to have the threat, of further disruption to sort of the trade, the North American trading bloc, have that threat removed. That's important. We surveyed our firms in Texas in these Texas Business Outlook surveys that we have, and we asked, are they more likely to be, how are they affected by tariffs, basically, in the short run and the medium run? And you can see here, sort of in the short run, 28% of the firms that we surveyed, 28% said that they were negatively affected by tariffs, and only 5% said that they were positively affected by tariffs. So we just wanted sort of to get a temperature check and make sure, if we're saying that tariffs are hurtful, that seems to be the case both in the short term and the long term. These are Texas Business Outlook indexes. This is so we've been looking mostly at employment, but this is for economic activity. And I just wanted to show you this because there's a divergence at the end of the year in terms of there looks like to be some weakness in manufacturing, whereas the service sector sort of turned up at the end of the year. And the reason I want to just point that out is that we're not making too much of this. And one main reason is that, the GM strike actually affected our data. And I think this is smooth data. If you break it out, we actually saw a slight uptick in the manufacturing survey in December. So we're not too concerned about this divergence. We think that the manufacturing sector is going to come back. One reason is, of course, uncertainty has declined. So this is our uncertainty index, just to show you again. This is one of the reasons we're a little bit more optimistic about 2020 is these decline in the uncertainty index suggests that, again, some of that trade policy uncertainty has been removed. And so partly as a result, company outlooks turned up. And I'm going to speed up maybe a little bit here. One really bright spot, as I mentioned earlier, in the Texas economy in 2019, partly due to probably the reversal of Fed policy and, the 3 interest rate cuts that the Federal Reserve executed in 2019, but what we did see was a very healthy housing response. So if you look at construction, here's multifamily permits in Texas, and you just see a very sharp increase there in the second half of 2019. So it really looks like building was quite spurred along, probably partly due to cheaper borrowing costs. And we even see a pretty significant uptick in the red line, which is the construction of single-family homes. So that's single-family permits. So we're really seeing improvements here in the construction market. And then we saw home sales that rose also on lower mortgage rates. So Austin, I mean, if you think that was, pretty positive news, obviously, whenever you show Austin there, it's off the charts. Like, there's no place in Texas that, of the large metros, no place grows like Austin. It really is quite an extraordinary economy. It's a standout in a state which is a standout. So you're the standout and the standout. So you're doubly lucky because you're in Austin. This is just comparing job growth across metros, and you can see Austin was the fastest growing in 2019 at 2.9%, a little bit less than 2018, but still the fastest growth among these large metros. When you look by industry, Austin employment gains were very broad-based, but we had a couple of standout industries in 2019, construction and information. So the high-tech sector, alive and well. I guess, Brett, you'll tell us about that here in a minute. And then construction also booming in Austin in 2019. If you take a longer perspective, you just get more overwhelmed by sort of what's going on in Austin. The income gains, for example, this is median household income from 2010 to 2018, and you can just see 20% growth in household incomes in Austin. Now, I hope, it'd be great if that's sort of 20% increase for everyone who was living here, but it's probably closely a lot of people who earn a lot of money are moving in. So there's some of that is net migration, some of that is income gains that are happening organically, but either way, it's the standout performance in Texas. Certainly very nice income gains, but with that comes higher cost of living. So Austin is also close to number one, actually number two after Midland in rent growth over the same period of time. So it's gotten more expensive to live here as incomes have gone up. I'm going to skip ahead here because I promised Gail I would not go long. So let me just skip to the outlook. So very solid outlook for Texas and for Austin really in 2020. Texas employment gains again are healthy and mostly broad-based. These 2019 headwinds are stabilizing, as I mentioned earlier. Construction and housing really remain very bright spots, and we expect that to continue. The year-end improvement that we saw, I showed you the declines in uncertainty, the resolution of some of those trade agreements, the improvement in company outlook, even though it was slight, but still important. So we believe those year-end improvements mean slightly higher growth in 2020 than we saw in 2019 for Texas. So really our forecast, although we haven't released our official 2020 forecast yet, that comes at the end of the month, but we're slightly above 2%, so a little bit better than than last year, I mean. And so what do we watch in the short run in terms of, things to be concerned about? We continue to be concerned about labor markets. They're very tight, very hard to find workers. Policy uncertainty still is out there. There might be some resolution of trade policy uncertainty, but there's certainly been an increase in political uncertainty, right? If you think about we're moving into an election year and so forth, there's certainly some policies by certain candidates that would really affect Texas. If you think of our energy industry, for example. We're watching global growth, of course, and oil prices. Oil prices, we always watch oil prices in Texas. What to watch in the long run? Really, again, immigration, because I think the long-run solution to what's really the retirement of the baby boomers and the aging of the U.S. workforce has to be immigration. The business climate, of course, is always a concern, maintaining the business climate. And lastly, climate change. And we are quite vulnerable, especially now we're the world's largest oil and gas producer. That's happened as a result of the fracking boom. So, and although we also have a large wind industry in Texas, we are the largest producer of wind energy as well as oil and gas. But still, we're very vulnerable to policies regarding climate change. And so we need to be watching that because we've got to change with the times in Texas like everywhere else. All right, thank you so much.
Thanks a lot, Pia. And to give you one sort of complementary data point, so you were talking about international immigration, and the full-time MBA market has felt this dramatically. So our international applications are probably down 30%. What we have done is shift an MBA program that was probably about 30% international is now about 22% international. And so that, I think, has important implications, and this is true across the country for top MBA programs, which I think has important long-run implications for the U.S. as a destination for talent. So something we're worried quite a bit about. So our next speaker is Britt Harris. Britt has more than 30 years of investment experience leading several of the largest, most successful, and most innovative investment organizations in America. In addition, he's currently a member of the President's Working Group for Financial Markets and advisor to the New York Federal Reserve. He is one of only a few people who have worked extensively in both the private and public sectors. He's currently the President, CEO, and Chief Investment Officer at the University of Texas, Texas A&M University Investment Management Company, which we all call UTIMCO, which is the largest public endowment in America. But we still need your donations. Right? Prior to UTIMCO, he was the CIO for the Teacher Retirement System of Texas, TRS, the CEO of Bridgewater Associates, and also the CIO and President for Verizon Investment Management Corporation. Previously, he was the Managing Director for Asea Brown Boveri in Europe. He got his start in his home state of Texas. He has been named 3 times as one of America's leading pension plan investment chiefs. He's been consistently named one of the top 5 asset investors in the world. In 2013, he was honored with a Lifetime Achievement for distinguished service to the financial industry. He also serves as an executive professor for Titans of Investing at his alma mater, Texas A&M University, but also we're very grateful now here at the University of Texas at Austin. He has guest lectured at all the top schools, including Harvard, Princeton, and Yale. In addition, he's a frequent speaker on various spiritual matters and serves on a variety of public and private boards. I want to add my own personal thanks to Britt. I was really excited when he got the job running UTIMCO. I think a lot about it. We go out and work very hard to try to raise money, and if he can just get a few more basis points, then he can overwhelm whatever I can do. So thanks to you and your leadership for that, and we're really happy to have you stewarding our endowment. So with that, please join me in welcoming Britt to the stage.
All right, good morning, everybody. Pia's presentation was really interesting, and I want to challenge the amenities section. I'm going to explain it as well. We were lower. Dallas Cowboys are down. UT football's down. A&M football's down. Those are all going to resurrect, and our amenities are going to flourish. And I don't think that factored in Mexican food or barbecue. So we're not that into opera. All right, so I'm going to give you a flyover of the last 13 years, which has really been extraordinary. You know, we've had the second worst financial collapse in the history of the United States in this 13-year period, and the longest and expansion in history right after it. And the last decade has been the best decade for U.S. stocks ever. So we've had, I call this feast and famine. I did call it feast and famine. Yeah, there it is, feast and famine. And we had the famine first. Now we've had the feast. And let's see where we're going to go. So I'm going to start out, though, with just an example. This is UTIMCO, and just an example of what has happened to us over this expansionary period. And you can take this as a reflection of what's happened to everybody. So in 2009, the endowment was worth $13 billion. Today, it's worth $38 billion. So just 11 years later, I think we've gone up $25 billion. So this has been an exceptional period of time for every professional investor who runs a globally diversified portfolio. And our purpose is threefold. One is to eradicate poverty through higher education. The second is to fund world-class research. And the third is to help cure and care for cancer patients and people with debilitating diseases. So can you imagine all the good that is coming from this asset growth that we've experienced? And Jay talked about the free tuition that is now coming to really deserving students that might not have had it otherwise. This is the overall picture. So the endowment's not the only thing we manage. We actually manage about $50 billion. So as Jay said, we're the second largest educational endowment in the country. And in terms of areas that are groups that manage endowments for education, we actually manage more money than anyone else. On your right-hand side, that just shows our diversification framework. I don't have time to elaborate on it, but we don't believe in traditional diversification because we have no interest in being diversified on average. We need to be diversified at the right time. And so when you need to be diversified, in our view, is when economic conditions change. So here's another one I can't explain to you, but But this basically charts out all the economic conditions that you can have between GDP and CPI, and we know that investment returns in every single box. So the vast majority of the time, the goal is to get you into the blue box. That's why I keep it simple. Just get me in the blue box. If you get to the blue box, equity returns typically have averaged 16% per year. And you're going to find out that's exactly what we've averaged for the last, ever since the expansion. And the goal of the Federal Reserve, when we're coming out of the Great Famine, was to lift the economy back into that economic zone. And what we've been able to do, and I'll show you kind of the premise of it and also the reaction to it and the results from it, was we've lifted ourselves just high enough in terms of economic growth, and we've lifted our inflation rate just high enough and kept it stable to move us into the edge of this blue zone. And we stayed there for this entire expansion, which is extraordinary. Here's where we were before. As we said, we didn't hardly notice this in Texas, but everybody else in the world did, or in the country. So during the financial crisis, 8.7 million jobs were lost. The housing, 7.3 million people lost their homes. Our U.S. GDP declined by almost 500 billion. And the reason for that, on the bottom right, is that we had an expansion in debt, particularly related to residential mortgages. And so at that time, the household debt to GDP rose to almost 100% of GDP. And GDP at that time, remember, was 14 trillion. So we had $14 trillion of household debt relative to GDP. That's where we were. It was a huge predicament. We were on the verge, literally, of a depression. Thankfully, we call this the Great Financial Recession. We were within a hair's breadth of calling this a Great Financial Depression. So I'm going to show you how we got out of it. But since we're on this page right here, I just want to tell you where these stats are now. So remember, we lost 8.7 million jobs. Well, since the end of the recession, we've actually added over 22 million jobs. Our foreclosures are way down. The U.S. GDP has grown to $21.5 trillion. So $7 trillion of additional growth in our country. And the household debt to GDP has dropped to 74%. So just great financial performance. Now this has been, it's funny because this has been probably the most hated, despised good news, that we just can't take good news apparently, in the history of mankind. So what happened? So with that financial backdrop, the Federal Reserve and the U.S. government, frankly, went to work. And the Federal Reserve dropped their discount rate by 500 basis points to near zero. Now, for those of you who don't have any reason to follow this, usually whenever we get into a financial problem like a recession, the history is you drop rates by about 500 basis points. So that's what we did this time, to near zero. There's probably some math majors in the room, and if we have another problem, near zero minus 5 is, not a number that we'd like to have, even though a lot of countries in the world have gone into that category. The Federal Reserve balance sheet expanded by 3.6 trillion. It actually went on up to 4.5 trillion. That's quantitative easing, and what that does is it, instead of lowering the discount rate, it actually, through the bond market, it creates a condition that actually simulates the fact that we would be like a minus 3% discount rate. The federal spending went up to 1.5 trillion, and the two objectives here were to get our economy back into what I'm calling the blue zone. And in order to get that done, we had to do something that people in general despised, which was you have to recapitalize the U.S. banking system. You have to recapitalize the financial markets. So that was politically unpopular, but it was absolutely necessary for our economy to grow. So here's what's happened. So this economy now is, this expansion is now 128 months old. The normal expansion is 48 months. On the right-hand side, you see all the length of all the expansions. And so here, the aqua line or whatever it is at the bottom, that's the expansion we've had here. So this is now the longest expansion in the history of our country, and it's also the weakest. So, we used to be traveling in a supersonic jet to get from A to B, and now we're traveling by car. But the point is we still got to be. It just took a lot longer. If we were, in fact, growing at the same rate that we'd grown in the last big expansion, which is the 1990s, we'd actually have $3 trillion more in our economy than we do today. And that expansion itself was the second slowest. So every expansion seems to be weaker and weaker, but they're lasting longer. So what happened in the U.S. stock market? I know everybody in this room was fully invested in the S&P 500, at the low, because from that point to this point, the U.S. stock market is up almost 500%. We've recently passed the high from the 50s, and this is just a truly remarkable result. If we were sitting in this room in May of 2009, no one, would have expected this outcome. And so I learned long ago the financial markets are a beast, is what I was taught. Sorry, Jay, that was the summation of my. They will do whatever is required to make us look stupid. Basically all of mankind. And thankfully, this time around, we probably didn't look brilliant, but we made a massive amount of money, so that salves our conscience. So here's where GDP was and inflation. So you see that big dip. The GDP was falling by 4%. We got it back up into the kind of 1 to 3 range, and we stayed there for this entire time frame. On CPI, it was also falling. I mean, the Fed is scared to death of declining inflation, and so because they don't have enough tools to fight it. So we got inflation back up to near the target. The Fed established a target of 2% for inflation rate, and the measure they use, as Pia showed, we're at 1.6. So if somebody said we're going to put $4.5 trillion into the economy through monetary policy, and we're going to put another $1.5 trillion into the economy through fiscal spending, and you ask any economist what is going to happen to the inflation rate, everybody would have said it's going to soar. And it absolutely did not soar for a whole bunch of reasons. Technology, globalization, the decline in oil prices, and so on. So it's a huge shocker. So here's where we were. So going back, what you find out is here's something that's absolutely true. Investing backwards is a simple game. So here at the bottom of the market, the PE ratio for the stock market was 11.3. If you look down and the rates, the Fed had dropped the rates to near zero, and the investment grade bond yield was 9.3, and high yield was almost 18%. And so from that level, if we could just get our economy back into the blue, the prospects were really high. And so as you know, we did get back into the blue zone, so now we're at 18.3. That is not a high number as long as we stay in this economic environment. Now, if we slip out of this economic environment, it is a high number. So we're really dependent on our ability to stay in this zone. And so the Federal Reserve has now said, we're going to do everything we can to keep this expansion going, which is an unusual statement, for them to make. It used to be we're going to take the punch bowl, away. That's not what they're saying now. And the interest rates, investment grade yields are now 2.9. So you're going to make 3% from bonds, plus or minus. High yields at 5.8, a scary low number. This is the U.S. dollar, and the orange line here is the federal debt as a percent of GDP. So you see that big spike in federal debt, that goes from basically 100% to 160%. And people talk about how much trouble that is, or may be. At the same time, our dollar has been relatively stable. If you look at the right-hand side, though, the orange line is the interest payment relative to the side of our GDP. So the debt service cost has fallen because of the decline in interest rates. So if you're running a company, you may have additional debt, but what you have, the percentage of interest that you're paying to service that debt is relative to your whole economic power is actually lower. So this has never been a problem as long as we keep our economy at a stable rate. We cannot have rates rise. We cannot have rates rise. Oil markets, you see this big spike. There was a Faustian bargain that the world had with OPEC, particularly Saudis, that they came out and said, look, the bargain is off. We are no longer going to stabilize the market. the Texas fracker is now too big of a situation, and so that bargain was eliminated immediately due to market forces. The price of oil dropped actually down to the 20s, and now it's sort of in the 50s. And we don't have a stabilizer now for oil prices that we did before at a higher level. So oil prices are probably not going to rise much. The good news is on the right-hand side, that for the first year ever, this is the orange line, for the first year ever since 1953, we now are a net exporter of oil. We are now not a net importer of oil. If you're my age or the age of some other people that are here, this was inconceivable, years ago. Here's the performance. Just, I said, when you're in the blue zone, stocks go up by 16% a year. We've been in the blue zone the entire time. They've gone up 16% a year. Completely, totally normal when you're in that zone. And now we're trying to protect that zone. Energy index, however, went down 10%. This expanse, this growth in stock market was pretty healthy. It was almost all earnings driven. Secondarily, there was some multiple expansion, but it wasn't the dominant thing, and dividends didn't really matter. Last year, the stock market went up 31%, and 87% of that rise was multiple expansion. And in the fourth quarter, when the Fed added more stimulus, the percent of the rise was almost 100% from multiple expansion. Rob actually asked me that question on the phone. So coming in for a landing, how do we feel about things now? We have bear market monitors, and we have 5 different gauges and a bunch of different signals underneath each gauge. And it actually, folks, takes a lot to take a $21 trillion economy down. This is not easy. It takes a lot of stupid people. And unfortunately, we find the stupid people among the smartest people. So in the internet boom, and finance, everybody was on board. But today, the signals are very low. The markets fall when you have recession, commodity problems in the commodity market, a policy mistake by the Fed, which they did make in the fourth quarter of 2018, which they rapidly corrected, or overvaluation. So we don't have any of those right now. The last thing is you'd have a speculative bubble. So here, that orange line is when we believe there's been a speculative bubble. So at the end of 2007, there was a speculative bubble in emerging markets. And if you look at the bottom, there was nothing in the long-term treasuries. But if you look at 2 years later, all of a sudden long-term treasuries are what are in a speculative bubble, and the S&P 500 is at the bottom. But last year and this year, we don't see any bubbles. And of course, there's a reason that when things happen, they call them shocks, because nobody sees it, and we don't see it. So 3 more slides. If you want to look for an issue, the relative valuation of growth stocks relative to value stocks is at an all-time high. And we've been seeing some weakening in the IPO market. Here's the 10-year rolling returns. So as you see here, it's usually between 100 and 300. We hit the 300 mark and we immediately have reversed. It's an interesting reversal though. You think the reversal was because we had a big loss. It wasn't. Last year was up 31%. We just happened to roll off a year that was up 50%. And that relative, moved us down, but we're back down in the normal range. And then this is my last slide, and I haven't even got the signal. I'm going to keep talking. So here's where we are now. It's pretty much what you heard from Pia. The U.S. economy is expected to continue to grow at a reasonable rate, not a fantastic rate, but a reasonable rate. Unemployment is expected to stay low. CPI is expected to stay low. Interest rates are always expected to rise. There's never been a survey in the history of man that I'm aware of that people didn't expect them to rise, but they're not expected to rise much. And the outlook for the U.S. stock market is positive but weak. So it's been an extraordinary. I hope everybody made a huge amount of money. We thank you for any contributions you made to our endowment, and I hope you're pleased with the results that we've had so far. Thank you very much.
Great job, Britt. Thanks a lot. Thanks a lot, Britt. I've had the pleasure of being around Britt several times now, and I will say every time I learned something, so thanks again for coming out. The stat that we quote here to make sure people don't think that we're just awash in cash is to take that 40 billion, divide by the number of students in the entire UT system, plus the A&M. Per student, our endowment is not outsized in the way that people might perceive. Okay, thank you. Our third speaker this morning is Brett Hurt. Brett is the CEO and co-founder of data.world, a public benefit corporation and certified B Corporation, the platform for modern data teamwork and the world's largest collaborative data community. Data.world's modern catalog for data and analysis awakens the hidden data workforce within every company, unifies silos, and creates data-driven cultures faster. In 2017, 18, and 19, Data.world was honored on the Best for the World list by B Lab, placing the company in the top 10% of all B Corps globally. He's also the co-owner of the Hurt Family Investments at HFI, along with his wife, Deborah. HFI is involved in 76 startups, 21 VC funds, and multiple philanthropic endeavors. He co-founded and led Bizarre Voice as CEO through its IPO, follow-on offering, and 2 acquisitions. Bizarre Voice became the largest public SaaS, software as a service business in social commerce. He also founded and led Coremetrics, which was rated the #1 web analytics solution by Forrester Research, and like Bizarre Voice, expanded into a global company and leader. Coremetrics was acquired by IBM in 2010. In 2017, Brett was given the Best CEO Legacy Award by the Austin Business Journal. He began programming at the age of 7 and doing so on the internet at age 18. He finished his free book, The Entrepreneur's Essentials, in August 2019. We are very proud to call him a McCombs and UT graduate. He earned his BBA from the McCombs School of Business at the University of Texas at Austin. Please join me in welcoming Brett to the stage.
Thanks. Appreciate it. Thanks so much. All right, I don't have any slides, but I've got a lot of thoughts for you. So I'm gonna talk in multiple sections. So just so you know where I'm going here. First, I'm going to talk about analytics and data. It'd be kind of weird if I didn't talk about that, given that I run data.world. Then I'm going to talk about startups in the Austin area and just kind of what I see happening with startups overall. Give you some overall kind of thoughts on technology, something I really obsess about and have since I was a kid. And then I thought it'd be interesting to share with you trends that I'm watching in technology for this decade, like the things that I think are kind of most exciting. So on the analytics front and data front, 2019 was a banner year. I mean, we've just heard about just massive expansion in the economy. 2019 was a defining year for the analytics and data industry on several fronts. You know, first of all, you probably are aware that Salesforce.com bought Tableau for, I think it was $16.7 billion. It's the largest acquisition in Salesforce's history. Tableau is probably the global leader in data visualization. They're one of our partners at data.world. It's a historic acquisition for Salesforce. And you might be wondering, why did they do that? And the primary reason is that Tableau is in front of so many different business analysts across the world, and Salesforce was worried that there were all these applications cropping up that were taking more and more of the data within Salesforce and presenting that in layer to the user. And so therefore, Salesforce was at risk of being disintermediated, basically just turning into kind of a dumb database with all these applications built on top of it. They wanted to own the whole stack and the whole application. Looker was also bought in 2019. They were bought for over $2 billion by Google. Looker is a major SaaS player in analytics as well. And this is a historic acquisition for Google because they've never bought a high-touch software as a service company like that. The closest acquisition would be something like DoubleClick, which they really bought because it's an ad network. You may remember when they announced the DoubleClick acquisition about 10 years ago. So that's a really big deal because Google tends to not want to do hardly anything that touches services. Looker is a really high-touch platform in the analytics space. So that's kind of something to watch. Is Google going to start getting more into services? Kind of the Silicon Valley ethos in general is we don't want to hire people at all. We want the machines to do everything, and Google's no different from that. Snowflake is the fastest growing software company now in about the past 5 years. And I'll make a prediction up here. Predictions are always scary. But if we continue to have a good stock market, I think Snowflake will have a $10 billion IPO this year. It's just an incredible platform. It's kind of a miracle that it even worked, because you have platforms like AWS, Amazon Web Services, which provide some layer of enterprise data warehousing. And Snowflake essentially is an enterprise data warehouse built for the cloud. But it's just taking off, and that's something to watch in the data space, is that there's a real movement underway for the cloud. That may sound overly obvious, but one thing that's been surprising to me in starting this business, this is my 6th business as an entrepreneur, is that actually the migration to the cloud when it comes to data has been really slow. And it's because people are so terrified of data ever leaving on premise, and they see a data breach by Experian, and so that just puts a real damper on things. And has really stunted innovation, because cloud innovation happens much, much faster than on-premise innovation. And one of the frustrating things about being in this space is if you talk with a hospital, for example, about data.world, and we are only cloud-based, we're software as a service and cloud-based. Snowflake is one of our biggest partners now. They're very reticent to allow data to go to the cloud, but yet their internal systems are probably less secure than anything on AWS. But that is just kind of the world that we live in. On the data.world front, it was a banner year for us. We have grown, as the dean explained, into the world's largest collaborative data community. You can join for free. There's tons of economics data sets on there. Lots of data sets about poverty, nutrition, climate change. It's pretty neat. Like every day I get a high just watching what the community is doing on data.world. And 2019 was really the year where we leveraged that to turn into an enterprise solution. We always knew that was our destination. And we won many Fortune 500 clients. And we did it because we had this ability to say, well, we've stood up the world's largest collaborative data community. Your company has its own community. It's just employees bound by kind of title and compensation. And it's really become pretty profound for these companies, rolling out to thousands of people each at many Fortune 500. So I'm really happy about that. And we found our product market fit on the enterprise side in enterprise data catalogs. We also acquired a company in 2019 named Capsenta. That was a proud kind of UT Longhorn moment, hook 'em horns, where that was a technology transfer company. It was a company that came out of UT, technology that came out of UT, and it's all based on graph databases. And so that's pretty exciting. It was a kind of a match made in heaven. They were based in Austin. We were based in Austin. They were essential for us being able to access data on-prem. So although we're only cloud-based and software service, we need to have the ability for highly regulated industries like financial services to be able to basically catalog the data that they had on their internal servers, and Capsenta allowed us to do that. It was also, I'd be remiss to not announce, kind of recapping 2019, that Spark Cognition, which is an AI company here in town, raised $100 million. You don't hear about $100 million rounds that often. That's pretty historic for Austin. It's very, very unusual. It's much more common in Silicon Valley. They're an AI company, which is really interesting. And I'm friends with the CEO of Mir there. I think they're a great company. On the B Corporation front, too, 2019 was really interesting. So, I believe in pioneering business models. I've been doing that since I was 24 years old. But I've also been able to help pioneer, alongside the B Corporation movement, kind of a new way of doing business. And 2019 started with Larry Fink announcing that basically companies would be required to do more than just service shareholders, but really how are they impacting the overall climate and the overall environment, and how are all their stakeholders benefiting. So that was interesting. And then the Business Roundtable, towards the end of 2019, came out with a statement saying that it's more about all stakeholders. So I think that what the net of this for me is, and I served for years on the board of Conscious Capitalism, is that we're seeing a global awareness in terms of capitalism becoming something that directly benefits society, And I think capitalism overall has done a miraculous job of benefiting society regardless, but it's becoming more conscious, and I think that's a really good thing for the world. On the startup scene, 2019 was amazing for Austin. It was a banner year in terms of venture capital. One thing that happened, the largest round was done by a company called RigUp, which is an interesting marketplace for the oil and gas industry. They raised $300 million, led by Andreessen Horowitz. I've lived here. I was born here in 1972. I don't know if I've ever seen a round that big in terms of a private company round. So that was really good to see that we're holding our own on the unicorn front. And we're the 11th largest city for VC capital in terms of companies raising VC capital, not in terms of how large our VCs are here. And that's kind of interesting because we're also the 11th largest city in the country. So it's this kind of interesting parallel in that numbers. One thing that I was really depressed about after Austin Ventures kind of imploded here and didn't raise their next fund, and I was at Austin Ventures for a while, seeing kind of what's happening behind the scenes, is that I thought, wow, it's going to take us a long time to fill that capital gap in Austin. And as a result, it's going to really mean kind of downtimes for startups and people thinking less ambitiously here because the capital wouldn't be as available. VCs tend to prefer to invest in their backyard, just like you would, so that they can help more, they can drive down the street, have coffee with the companies, et cetera. But that hasn't happened at all. There's been a launch of many different VC funds, so there's a lot of good times on the VC front here. Many funds have cropped up. And including Silverton has gotten bigger, Next Coast Ventures, Live Oak has gotten bigger, and there's many new ones as well. And there's an interesting diversification where there's VC funds now specifically focused on CPG and consumer products, and so I think all that's great. It's the best time to be an entrepreneur in the history of the city, so it's a phenomenal time from that standpoint. One thing that I worry about on the startup front is just kind of the overhang of WeWork and the SoftBank investments overall. But frankly, I don't think this means that we're about to have a dot-com crash. I think this is just a sign of a good rebalancer. And there was just kind of one player which was like so ahead of their skis in SoftBank that kind of rebalancing is good. It's not a systematic problem, in my opinion. I think startups, we're in the golden age of technology. Startups overall are doing extremely well. VCs overall are doing extremely well. So that's my opinion on it. If you don't read Matt Levine from Bloomberg, you're really missing out. That's a free newsletter. You should really sign up for that. Like what he wrote about the WeWork debacle is kind of fascinating. And there were many, many, many problems wrong there. But again, I don't think this is a systematic issue. There's a tremendous opportunity here, as I mentioned. Some of the companies that we're investors in that I think are going to really just have historic impacts in the city. One is Everlywell, which is just an amazing company. I think that's going to be a unicorn one day. Dosh is a very interesting company. Alert Media is doing extremely well and it's kind of under the radar. Most people don't know about it, but that company is doing incredibly well as a software as a service company. And then you have these kind of engines of Indeed, just hiring, it's something like 4,000 people in 2019. And WP Engine, which is run by Heather Brunner, who used to be my COO at Bazaar Voice, and she's absolutely an incredible leader. And one thing to watch is that out of Bazaar Voice now, there's been 48 startups birthed. And so when a company has like really outsized returns, you see it birth a lot of startups. And I expect that'll happen with Indeed and WP Engine in a major way. Also on the Austin front, you might be wondering, like, what is my opinion on Apple and Oracle and Facebook and Google kind of beefing up here so much? I used to be kind of down on that a decade ago, and the Chamber of Commerce would come to me and say, like, what do you think about this? And I would say, well, I'd love people to be moving their headquarters here. I don't want us to be kind of like the India of Silicon Valley. But what I found is that it actually really drives the entrepreneurial engine because people eventually will spin out of those companies and start their own companies. And so I think it's a great thing. I'm like turned into a major, pro on that in terms of entrepreneurship, and it's just pretty going to have a pretty big impact, I think, on startups overall. I mean, Apple having their second biggest headquarters here is going to be kind of crazy. My book, The Entrepreneur's Essentials, as Dean HARTZELL mentioned, it's free. You can get it on Medium. There's lots of thoughts on entrepreneurship in there. I'm not trying to sell books. That's why I gave it away for free. Seth Godin gave away his first book for free called The Bootstrapper's Bible. I'm a beneficiary of that, so that's kind of why I did that. So overall, tech thoughts. For me, it's a very strange time in the history of tech. I'm like a dual mind. So like on one mind, I'm a huge believer in abundance. There's a book called Abundance, which is amazing. And if you haven't read it, highly recommend it. I'm reading a new book right now by my friend Andrew McAfee called More from Less, basically about how we essentially are getting much more from a capitalist perspective, a consumer perspective, than ever before by using less materials. So it's very counterintuitive to what you may think, in terms of human population growing and everything else. Capitalism has been a big savior there. But then on the flip side, you have books like Homo Deus by Yuval Harari, which are real, kind of fear-mongering books about what's going to happen with AI and machines merging with human beings, and are we all just going to be kind of obsolete, and AI is going to kind of take over the world. So it's an interesting time, and people like Elon Musk are like, AI is as dangerous as a nuclear weapon, and most entrepreneurs actually don't believe that. But it's also this interesting time of policy, and tech policy, in governments really kind of growing. So you've got the Consumer Privacy Act in California. You have GDPR in the data space, which where there's all this regulation coming in, and you kind of have this general kind of tech backlash in this history of the golden age of tech, where there's this amazing abundance, and a lot of that is kind of self-inflicted by technologists. But it's a strange time because I've been an optimist for so long, since I was just a kid. I was lucky to have a mom who learned how to program with me. That's why I started at age 7, because she thought it was strange that I was so interested in computers, and she wanted to learn along. And then she had the wisdom to not force me to be kind of quote-unquote balanced. She just let me program over 40 hours a week from age 7 to 21. Turned out to be a good career. It was not a great way to grow up in Texas from a social standpoint. It meant I got picked on a lot. A lot of people are like, he's not playing football, he's not doing anything else but this. But I've been passionate about it, since then. I'm still super passionate about it. The kind of backdrop of this, you've got this massive polarization in the country. I'm not really educating you on that at all. People voting, specifically along party lines, and then the world too, getting more polarized. Versus, kind of the promise of tech of bringing us together. So I'm going to be really interested. I've done a number of podcasts on what I would do if I was Mark Zuckerberg, which clearly I'm not. But this is going to be an interesting year, because this is 2020. This is an election year, and Facebook really hasn't changed hardly anything. And so it'd be a really interesting year to see kind of what happens on tech and what the backlash is as a result. We're doing our part at data.world. We are focused on collaboration, not polarization. We've designed our systems very deliberately that way. As a B corporation, so far, it has not turned into any type of cesspool of polarization, and I'm not going to let it do that. In terms of trends that I'm watching this decade, I'll keep this really short. I'm really fascinated, obviously, with data. One of the companies that we most recently invested in is called Orbital Insight, which takes data from satellites and makes it usable so it can look at, shipping data, like literally how ships are moving on the Earth, where you can study your competition, or you can study like how certain goods are flowing. And it's just fascinating. I mean, that kind of like the digitization of the world, I think, is very fascinating. I'm super obsessed about this whole clean meat movement. I think this will be the decade where we see it. Meat is a $1 trillion industry worldwide. We're getting very efficient at making meat from the cells themselves. This is called cellular agriculture. I think this is really important from a climate change perspective. Meat contributes around 40% to our climate change problems. And we've essentially turned the earth into one giant farm and cut down over 40% of the rainforest just to graze cattle alone. And so I think that, capitalism has taken meat to this level of efficiency where I don't think it can get that much more efficient. That's why China buys someone like Smithfield in terms of pork and want to make it efficient in China to feed their growing population. But I really think that that needs to happen. You need to have a new technology curve where it just breaks through. And the breakthrough is going to be essentially, I think, cellular agriculture, where it breaks that cost curve, where there's a company we just invested in, which I can't name it right now, but it'll be in the news pretty soon. But literally like a tenth of the water cost, a tenth of the feed cost from conventional grown. So I'm very fascinated about that. Very fascinated in terms of nanotech and biotech. Like really, you should watch CRISPR and gene drives, and all that stuff's going to be very interesting this decade. Very fascinated in solar. Every time I go to TED every year, every time I go to TED, it seems like we're advancing on solar at a much faster pace than most people realize. Like a shock to the system, for oil and everything else is that we have complete abundance from the sun that's mostly wasted. Eventually, we're going to get battery and everything else to the point where it just completely breaks that industry. I would not at all invest in oil. I used to be in MLPs. I got out of MLPs completely years ago. I'm like, if I was an MLP holder, I'd be terrified that like eventually, you're going to wake up and read this article. And it's going to take a long time to replace all the infrastructure, but you're going to reach this article where it's just stupid to use oil at all. And then, of course, SaaS and cloud, I think, is going to continue to really rapidly grow so that people don't have to buy infrastructure, can just do everything virtually. As a Tesla owner, I'm very interested in autonomous driving. I'm also interested in it just from a trends perspective, from the standpoint of that's such a big producer of jobs. So this will be an interesting decade. I think we'll see in this decade whether or not we actually can do autonomous driving. I'm a little bit skeptical, even though Elon Musk always says it's going to be next year. But I'm a little bit skeptical because there's just so many variables to it. And I think it'll be a real harbinger of AI and whether or not we can get efficient with AI. If we can't get autonomous driving right, it's hard for me to believe that anytime soon we're going to replace highly creative jobs with AI. So I'll be watching that as well this decade. Thank you.
Thanks a lot. Yeah, please. Thanks a lot.
Thank you.
Thanks, Brad. Just to tie together a couple of themes I heard today, I was talking to one of our graduates who's a hedge fund manager, and he was talking about how they're trying to make bets on oil and gas, and they've got oil storage tanks, the top floats, and so the shadow they cast is indicative of how much oil is stored. So they've got satellite imaging figuring out, based on the depth of the shadows being cast at that time of day around the world, how much oil they think there is being stored, and that gives them signals to trade. But how this all sort of weaves together, I find fascinating. So we've got about 10 minutes or so left for Q&A. I'm going to go sit down. We've got mics in the front. This is being recorded, so if you wouldn't mind using one of the mics. But with that, I'd invite somebody to please come down and get this kicked off for our speakers. Questions? I can cold call, too. I'll start, and then I'll give you time. So, Brett, you mentioned the venture community, and one of the things I've heard over the years is one of the things that holds back Austin from a unicorn or home run standpoint is the lack of presence of big venture capital firms. And BRITT, you all are you see capital flows and think about that. Is Austin, Brett talked about we're actually doing better there maybe than we used to, or are we really behind or not in the formation of the venture community in this market?
Yeah, I actually believe we are.
Yeah.
So, we haven't replaced the gap from AV entirely yet, but we have a much more diversified system now with many VCs that are, in the 100, 150 million fund range, and then some that are like 30-ish million, and they're all growing fast. And so I'm bullish because the gap is going to be filled, I think, pretty quickly over the next few years. If I could wave a magic wand, I would have 2 to 3 funds here that were in the $300 to $400 million range, and that focus specifically on investing in Series B or C's, and because that's where the biggest gap is. It's not at the Series A level, at the initial level, but it is at that. The sad part about that from an Austin perspective, it's fine for the companies, is that once you raise your Series A, you prove product market fit, you for sure go to Silicon Valley or New York, but definitely Silicon Valley, and you raise money from there, and the beneficiaries are the LPs in those funds and everything else, of which includes people like UTIMCO, but it's really kind of more geographically centered there. And I think that's kind of ridiculous for a state that is the second biggest state economy in the US and has just such a big GDP overall as a state. So I would like to see that problem fixed, but I think that I'm not depressed because it's getting fixed quickly. That's my opinion.
We were not on the radar screen really 20 years ago, and now what are the third or fourth venture capital market in the country at this point?
Well, actually, the latest stats were kind of 11th.
11th?
Yeah, the 11th. Yeah, the 11th, which I said kind of mirrors that 11th largest city. So we've still got a ways to go there.
So behind but improving is kind of the story.
But people are thinking super ambitiously here. It's super exciting time from that standpoint. It's just we do need some bigger funds here.
Questions?
Thank you. Question for Ms. ORRENIUS. Sorry if I'm mispronouncing that. A couple of your charts on exports, the export growth in Texas, to what extent does LNG and energy exports contribute to that? And then a related follow-up. The decline or slowing of the rig count, is there a constraint or a bottleneck related to energy infrastructure, transportation, refining infrastructure, either lagging or being constrained by some other force or forces that's causing that slowing on the production end, but an increase, so I understand, on the exports of energy? Can you address that midstream part of the industry?
Absolutely. Most of that growth that you saw in that chart is accounted for upstream and downstream energy. So the initial part of that period is all petrochemicals on all the downstream in terms of, we're a huge exporter, not just gasoline, but other petrochemicals and plastics. So that's been incredibly important. And then more recently, when they removed the crude oil export ban that had been in place since the 1970s, that was actually, I like to cite that example because it's one time that Congress actually did something quite valuable. So they removed, really, it's fell out of a lot of attempts. But so they did something really smart, and it's been huge for Texas. Maybe not so good for climate change, but so it's been, the bulk is driven by energy, of course. But then you also referred, so what happened when, especially with the lifting of the crude oil export ban, and you're referring to this in your question, is that, of course, we couldn't, and then the massive explosion of production in the Permian, we didn't have the pipelines to move the oil from the Permian to the coasts fast enough. And so it was interesting for economists because we could see the oil, the Midland, what we call the Midland oil price, and compare it to the Gulf oil price, both for WTI, and just see the huge gap as the Midland oil price would go down, 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 and the Gulf oil price go up, up, just because there's no way to transport the oil, and they started moving it by train, and they started moving it by truck, which is extremely expensive. But most of that has been resolved now. We saw talk about investment. We saw huge investment in midstream, lots of construction of pipelines coming online. So Texas did a great job, allowing that construction to go forward, and investors came in and they took care of that. So I think mostly we're okay now in terms of being able to bring oil to market and natural gas as well. You mentioned LNG. We certainly have quite a bit of investment, huge LNG projects along the coast, Corpus Christi. And so we have the LNG exports now as well, which is huge and very important as well. But I think the problems in the energy industry are more around currently, and what has really developed the last year and a half is really more about returns to investment and a drying up of credit for energy producers. And so with that, more demands on the energy industry to show profits and so forth. The credit has dried up, and then there's been some technology issues with the fracking as these wells grow longer and longer, and they start running into each other, and then the production rate go down, and so there's some issues there as well. So they're struggling right now, but in terms of the midstream, I think that's been largely resolved.
Britt, do you want to talk about what you're seeing from capital flows to energy?
Yeah, so a lot of discussion has been here about around renewables or climate change. And I have no idea if climate change is good or bad. Historically, we've been in a range, and we get to the top of the range, we've always dropped down, but for some reason, people believe we're going to go through this time. And from an investment perspective, it's kind of moot, because what we know is pretty much the whole world, particularly outside of the U.S., has bought into it. And so what that means is there have already been laws created and political requirements put in place that are going to cause a massive shift in capital allocation towards renewables. So it's hard to get the numbers, but I was able to find one, or we were able to find one. I don't do anything myself. And here's the stats. $1.5 trillion historically has gone into the traditional, primarily, energy complex worldwide. For the next 30 years, that number is going to grow to $3.5 trillion. So an additional $2 trillion for 30 years, so $60 trillion is expected to go into the renewable sector, over the next 30 years. And some of that may also come out of the conventional energy companies. So that's probably the biggest capital flow that'll occur in this decade.
All right, I'd like to get everybody out. Please come down. You get the parting shot, so no pressure.
I'm fascinated by inflation, and you spoke of shocks or the things that people don't foresee. But do you see some potential, say 10 years within this 10-year time, for inflation shock and what that could look like or become?
Yeah, so, Pia's probably better answer this. My answer is I don't know anything.
Good answer.
Yeah, but there's no, right now, based on what we know today, there's really no reason for an inflationary shock. Now, if we switch our political system to populism or socialism or something like that, then that would be the biggest danger in my mind. And people are very, if we get a big acceleration in wages, that would also be an issue. So those would be the two I can think of.
One of the things I would watch, I think that keeps inflation in balance is just the amazing efficiency of technology. And I really think we're getting better and better there. There are limits to productivity gains and stuff like that, but there's a huge case here that we should want AI and robotics as fast as possible from an efficiency standpoint for the entire world. There's so many things that are done inefficiently, and I think this will be the defining decade for that. I think we'll conclude at the end of 2029, was this a decade where we actually proved that we could make that kind of progress and increase efficiency, which would keep inflation, pretty much in check. And if technology continues to break all these cost curves, if I'm right about, and more importantly, this company you invested in, about meat, for example, you don't need to have a lot of land or, put animals in these big, cages and everything else. You can just, directly do it straight from the cells. And there's so many examples of that I participated in my previous companies in software as a service, where we help make industries a lot more efficient. We're doing that at data.world too. So That's the thing that we're in the golden age of tech that can really keep inflation in check.
Great. Well, we're out of time, and we want to honor that, but we want to say thanks for coming. Thank you very much to all three of our experts up here. If you have suggestions for future people, topics, issues that you'd like to see in this series going forward, let one of us know. Hope you'll stay in touch with us over the coming year, and thank you all for joining us. Please, round of applause for our group.